Today's speaker is Steve Lentz, and he's the Director of Education and Research at OptionVue. He's a big MetaStock user. I've met him several times, and a very nice guy. It's his first presentation here at the MetaStock group, so we'll have to give him a bit of a rough time just to kind of help break him in. But I'm interested to see what he has to say. So let's go ahead and bring you on, Steve. Steve, can you turn on your microphone?
There we go. Hey, Jeff.
All right. Hey, I can hear you. That sounds great.
There we go. Now I'm excited to be here.
Okay, you sound good. Let me go ahead and turn the presentation over to you. It should just pop up a note on your screen.
There we go.
All right. And then just to
perfect. All right.
Just to tease you a little bit, what do you have to say about yourself?
Well, I'm with OptionVue Systems, and our educational arm is Discover Options. And OptionVue has been in business since 1983, primarily involved with the high-end analysis of options position and options modeling. We've kind of occupied that niche since then, and so that's our platform. That's our flagship product is OptionVue 8 right now, and then Discover Options is a mentoring program that we have set up for teaching people how to trade options and all the way going up to sophisticated money management models. Today is a little different, though. We want to, get into volatility trading with a system that we've developed here.
Robin, just to answer your question real quick, we are recording today's event, and we will have it available within a couple of days. It'll be up on our YouTube channel. So I'm going to turn the time over to you, Steve. Let's go ahead and get going.
Okay, perfect. Thank you. So, folks, we are talking today about trading from the perspective of volatility and getting some outrageous returns. Now, outrageous is a tough, it's a strong word in the world of investing, but here is an equity curve of the VXX Trading System that we rolled out here live on March 6th with a set of rules that has been very good for us. And what I want to do is tell you about the system. We do offer a service regarding this, but I'm going to explain exactly all the theory and tools that we use that goes behind the system, and I think you'll find it very interesting. It's a different angle than I think perhaps you've seen before. And so this is an equity curve of the signals going back to March 6, 2016, just last year. The important numbers are in the bottom right corner where you see the return since then is 175%, and the annualized return then is 201%. This is through today's close, by the way. There is the drawdowns. Here you see 46.5%. That's of that initial 10,000. So you do have some volatility here. And so what I want to do is tell you exactly what the system is and the theory that goes behind it. So this is developed by Len Yates, the founder and president of OptionVue Systems, and we call it the VXX Trading System. It times your entry and exits for capital to be used in one of the three following fashions. One, you could be long the VXX, and that's an exchange-traded note, or your capital would be invested in long the XIV, shares in the XIV, which is an inverse of the VXX, or your capital would be used just to simply be on the sidelines in cash. All right, let's talk about the VXX and the XIV a little bit and get into exactly what you're getting when you purchase shares of either of these exchange-traded products. And here's what they do. The VXX is an ETN, exchange-traded note, that manages a long VIX futures position. All right, and so when you buy shares of the VXX, there is a fund manager that is taking the money and then managing a position in the VIX futures. The VIX is a measurement of the implied volatility of the SPX cash options, which is basically a measurement of the expectation of future movement, or some call it the fear factor, if you want to call it that. But now we have futures contracts on that volatility number. And it's turned into just a wonderful instrument for portfolio managers to efficiently hedge their holdings using VIX futures like this. So the VXX manages a long VIX futures position, and the inverse is the XIV, which is an exchange-traded note that manages a short VIX futures position. So just to make it clear, we're not using our own money to trade VIX futures in any way, shape, or form. We are instead purchasing shares of an exchange-traded product that the manager then does the actual futures trading, okay? So we're just purchasing shares of either of these, not actually trading futures. All right, so just as an aside, what I'm leading up to is we do offer a service along the lines for this VXX trading system, email trade alerts. We'll give you the proprietary indicators on our website and also through our software and monthly status emails, but more about that later. But that's kind of where this is leading up to. But I first want to, I'm going to disclose all the theory and the tools we use behind this. The VXX and the XIV are very liquid exchange-traded products. You can easily get in and out of these. The VXX averages volume is over 80 million a day, 80 million shares a day. XIV averages over 30 million shares per day. So when you do have an alert fire, it's easy to get in and out of these, all right, as opposed to trading thinly traded options where the bid and ask spreads can be quite wide and difficult to fill sometimes. That's not the case here. Now, the core indicator that we're using here is called the Yates VXX indicator. It is basically a moving average of a component I'm going to fully explain here. But we have this indicator, and it flashes buy and sell signals or getting into cash signals. And so here are the signals that have occurred since we went live back in March. So when this indicator went above 0.83 back on March 7th, all right, that was a signal for us to invest our capital into the XIV, exchange traded product. And then when it descended back below 0.83, that's the threshold that we've discovered is optimal, we exited back into cash. That was about 3.5 months that we were long the XIV. So the signals on the system last, weeks to months at a time. This is not a swing trading approach. You're not getting in and out quick. We're basically buying and holding for weeks to months at a time. In this case, we waited another 2 weeks and then went back long the XIV over there in July. And then we were long the XIV going all the way to, it looks like, early November. Right around November 1st, we exited back into cash. And then most recently, in mid-November, we went back long the XIV, and that's where we are now, is long the XIV. So the system has gone long the XIV 3 times and exited into cash twice since March there. Okay, now what I want to do now is take these signals and dates and superimpose them on a price chart of the XIV and just see how well these signals did. Okay, so here's a MetaStock chart of the XIV, and you can see over on the left, let's just walk through this. It went long the XIV on March 7th at 21.18. It was long the XIV and exited into cash there on June 23rd at 30.05. So that was a gain of near $9. What's that? A gain of what, 45%, something like that in 3.5 months. Not too bad. We waited a couple weeks and then we went back long the XIV on July 7th at 26.52. We were in it for about 3.5 months until we exited into cash on November 1st at 35.82. So that was a gain of what, $9? Pushing over what, 34%, 35% gain, something like that. And then we went back long on November 16th at 40.45, and it's over 55 at this moment. So another good gain right there. And so here we have gains of 40, 30, 40, 45%, 35%, another 40%. When you start adding these kinds of gains up, you can get some significant returns. And so what we did is, before we went live on March 6th, we back tested this going back to 2009, and starting at $10,000. And what we're proposing that our folks do is that they take a portion of their capital and allocate it to this, such that when you are into cash and then reinvest back in, that you're investing at full capacity, purchasing all the shares of the XIV or the VXX that you can with the capital you have at that time. All right, so you just take a portion of the capital allocated to this approach, and then you constantly reinvest. And if you had done that starting in 2009, you could see the system would have built up to over $2 million today doing it this way. And when you have gains of 30% here, 45% there, you can see how that is achievable when you fully invest each time. So how in the world is this possible, though? I mean, what in the world is going on between the VXX and the XIV to make these kinds of gains possible? And so this is something that we discovered, and it's called the daily roll. The daily roll. This is a phenomenon in the market that has to take place with these particular products that's very important for us. So I'm going to explain this, and I think it'll start to really make a lot of sense when you look at this list of VIX futures contracts and their pricing. We have at the top the near month, January, going out to September, farther out in time as we go down the screen. Notice the prices of the VIX futures that were at 1220, and then we go up to 1925. And so this is an upward sloping term structure, a price term structure of the VIX futures contracts. Now this is kind of in a bull market, and this upward structure is typical of a bull market, meaning that we're bullish. So in the near months, we're fairly confident things will stay bullish. Now, we all know when the market goes up, it goes up in a less volatile fashion than when it goes down. You know what it's like to be in a bear market, right? In a bear market, the daily bars are huge, the openings there's gaps everywhere. It can be crazy and volatile. So the market goes down in a much more volatile manner than when it goes up. And this is reflected in the VIX futures. There's an expectation that the near months will be less volatile because we're near month, we're bullish. But in the more distant months, we have less certainty about what life is going to be like down the road in September. And there very well may be bearish moments between now and then, and so that's why the VIX futures are priced higher in the distant months. Now, contrast that in a bear market. If we are in the middle of a bear market right now, then in the near months, we can expect more craziness over the next month or two, but we have more confidence. You know what? 9 months from now, by then, things will have probably calmed down. The market will settle down and probably start creeping up again in a less volatile way. And then you would see this term structure completely inverted, where the fatter months would be up at the top, the more distant months would be lower. And that would be a downward sloping term structure in that case. Now we're working up towards the daily roll, okay? So the way to explain this is really to go to the source and give credit where credit is due, and that is with the godfather of options theory and education, Larry McMillan. He has a great newsletter. In his Option Strategist newsletter back in February of 2012, he introduced this concept that then our president and founder, Len Yates, took that concept and spent quite a bit of time fleshing out a trading system and codified this idea with some timing indicators and everything I'm going to explain here. But I'm going to go straight to Larry because he explains this in a very efficient way, all right? So here we go. We'll just read it verbatim here and go slow. Both the VXX and the XIV are constructed in such a way that they actually own, in the case of the VXX, you own or are short, XIV, the two VIX nearest months futures. Okay, got that? They actually own or are short the two nearest month futures. Each day, part of that position is rolled forward so that a constant 30-day forward position is simulated. When the term structure slopes upward, as it does most of the time, that daily roll is a debit. So just back up here. The VXX has positions in the two front months that are long. Long a little bit of the first month, long a little bit of the second month to simulate a constant 30-day forward position. The XIV is short the two VIX nearest month futures, okay? When the term structure slopes upward, that daily roll is a debit and is a drag on the performance of the VXX, vis-a-vis the VIX. However, since XIV is opposite, it is a boon to the XIV. All right, now on the next slide, I'm going to show you the numbers and how this works. Conversely, when the term structure of the VIX future slopes downward, okay, that is in a bear market, the daily roll forward for the VXX is a credit, allowing it to outperform the VIX and consequently is a detriment to the XIV. Let me show you this just using these numbers here. Look at the left side of the screen if you could, where it says VXX. We're long the two front months, okay? So we have a long position in January and a long position in February, and every day to simulate that 30-day forward contract, we constantly have to sell a little bit of January and buy a little bit of February and maintain that constant 30-day forward contract. And so when we sell a little bit of January and buy a little bit of Feb, look over at the prices of these futures contracts. Do you see how then we're selling at a lower price at $12.20 and buying at a higher price, $14.20? That's a net debit. Every day that daily roll is going to dig into the price of the VXX. We're selling low and buying high. We don't want to do that. Now, look over at the XIV. That's the position where we are. The fund manager of that XIV has to every day, okay, maintain a short position, so he is short the front 2 months, January and Feb. So to maintain his constant 30-day forward contract that is short, he then has to roll from Jan into Feb a little bit every day, and he is then buying a little bit of Jan and then selling a little bit of Feb. And do you see how then we're buying low and selling high? That's a net credit, and so that net credit is constantly being added to the XIV price. That daily roll is helping to bump up the XIV price, and that effect of the daily roll can be quite beneficial. And so let's go back to Macmillan here. So hopefully you understand that daily roll that has to occur to keep that 30-day forward contract. So here it is. The idea behind the system is simple enough. When the VIX futures slope upward steeply enough, that like they are now, that is a roaring bull market, and we want to own the XIV. That means we want to be short the VIX because the daily roll is beneficial, like I just showed you, and because the VIX is expected to decline. Now, on the other hand, when the slope is downward, like in a bear market where the front months are fat, we want to do the opposite. We want to own the VXX because then the market is bearish, VIX is increasing, and the daily roll is beneficial to the VXX. So, folks, it's kind of like we're on a sailboat. And when the market is super bullish and that daily roll is benefiting the XIV enough, we're going to open up the sail and go in that and gobble up that daily roll in that direction of the market. And then when that daily roll begins to wane and come down, we're going to pull the sail in and go into cash and wait. And we're going to see which way the daily roll is going to get fat again. If the market gets bearish and the VXX is benefiting from the daily roll enough, we're going to open that sail up and go. Now, what's happened this year is that the XIV direction has happened 3 times now. And we've opened up the sail 3 times, and currently we're riding that wind right now in that direction. So that's kind of the idea here. And to navigate the timing of opening up the sails or going into going into XIV or VXX and monitoring that daily roll, we have to have tools. Any good sailor has to have good navigational tools to help them out. So I'm going to explain to you what the navigational tools we use here at the VXX Trading System. So here's what we do. We have an indicator indigenous to OptionVue called the VIX diff, VXDIF. And it basically is a measurement of the second month minus the front month VIX futures. You see the difference there? If you take the second minus the first, 14.20 minus 12.20, that's $2. And in the OptionVue in the change column, we're going to put the number 2. Now, in an inverted, where we have a downward sloping structure, that number can actually be negative. And so we can't really show a negative number in last, so we're just simply going to take that VIX diff and add it to the number 10, so that 10 is equal to base 0 basically. So anything above 10 is a positive VIX diff. Anything under 10 is a negative VIX diff, meaning we have the downward sloping price structure there. Okay, so this VIX diff is helping us understand that daily roll. And so what we've done is we've gone back in time, looked at the price of these front months going all the way back for years, and we've actually graphed out the VIX diff. Open, high, low, and close, monitoring that price structure every day, going back for years to help build this system up. And what we do is we take this price chart of the VIX diff and we throw on a moving average. In this case, it's a 15-day simple moving average. And what we've done is, over the years of honing this system, we've really looked at this moving average and have done some work on it and have created now what you see down below called the Yates VXX indicator. Notice that the lines look similar, but they're not precise. And that's because Len, when he built this indicator, did some volatility weighting to it. So it's not exactly a simple moving average. It's a proprietary, proprietarily adjusted, volatility adjusted 15-day moving average of that VIX diff number. All right. Now those purple lines down there, that's called the danger indicator. That's something that we can't, I don't have time to get into that. That's just a discretionary tool. But this Yates VXX indicator is what gives us the timing aspect to this, so that whenever it rises above 0.83, we're long the XIV. Whenever it goes below that threshold, we're into cash then. If it descends down below negative 0.6, then we have we're going to go long the VXX. That means that the term structure is now downward sloping enough. We're going to go ahead and pull the trigger, go into the VXX, and get the daily roll coming in that direction. If it rises back above negative 0.6, we're back into cash then. And so this is what gives us our signals, is this 15-day volatility adjusted moving average of the VIX diff. That is the thrust of the trading system. By the way, this is from 2011. This is when the VXX, when we were long the VXX, it dropped below negative 0.6 back then, and this is from 2011. On August 5th, we were long the VXX for another 3.5 months, and that was a good 50% gain in that, for that particular signal there. Just to, show you that on the VXX side, we have had some signals here, and that was, of course, a bear market then, when that was the market was going down at that time. Okay, so the bottom line is, the premise is that we want to be in a position to take advantage of that strong daily roll. Now, how big can it be? How much of a difference can it make? That daily roll that I showed you was contributing to the XIV or the VXX. So here's an example. From Friday's close, or nearby, I think it was the close. Yeah, we have an indicator we can give you called the XIV daily roll effect. And in this case, if the XIV was at 55.23, like you see on the first line, 55.23, $55.23 per share, that day's daily roll was contributing an additional 36 cents to it. Now, 36 cents contributing to 55.23, that was just that day's daily roll. That works out to 0.65% times 21 days in the month. You know, that number, if it were consistent on a, for the rest of the month, that was the contribution of about 13.7% just for that month. All right, so you can see that if you're on the correct side of the daily roll, it can really add up, not only on a given day, but after weeks, after months, and indeed going years back. Being on the correct side of that daily roll really can be, when you fully invest, every time you go back in, this is the kind of return that you can get. And we've seen it playing out here in real time since March 6th, so we're real happy about this. At this point, if you're still interested in this and pursuing this, we have a few resources we'd like you to look at. You could go to VXXTradingSystem.com and register, and we will get you an ebook that explains this in writing. For those of you that really like to study it and get the narrative in writing and in text form. Also, Len Yates came out with another video. That he has a 28-minute video that really goes into why portfolio managers use the VIX futures, why the VIX futures are priced the way they are, and that daily roll effect, and it'll just educate you more straight from the developer's mouth here as to why this works. And I'd encourage you, go to the website and register for the video and the ebook, and then if you're convinced and want to participate, you could actually go then subscribe right there. It's $1,200 a year, and for that we give you email trade alerts on the day that a signal fires. In the middle of the day, you'll get alerted to, hey, before the close, this is what, the system is flashing, you should go into cash. Or the system is flashing, you go into the XIV or the VXX. And I went and audited when those signals were flashed. I checked my emails, and those all fired a good hour and a half, 2 hours before the close of the day. So it's not like we're hitting the close and then, oh, by the way, this is what fired. No, you're getting in the middle of the day. Also, we will make available to you all those indicators I just showed you through our member section of the website, or if you're, if you're an OptionVue 8 subscriber or an owner, those indicators will be made available to you through the software as well. We also kick out a monthly status email kind of summarizing the way that the month went. On our website for members, we do have a screenshot here showing you every day at the close what you would see. The structure of the VIX futures. You're then getting the daily roll effect for the XIV and the VXX and a few other indicators as well. So every day you could log in and kind of see where things are at this way. Okay? And that is the presentation. I think we explained hopefully everything to kind of give you a good beat and a background on how this thing works. Hopefully you'll take the next step, educate yourself more on our VXX Trading System website, watch that video, read the book, and we would love to see you subscribe and take advantage of all the hard work that we put in, and especially kudos to Len Yates for developing this and flushing it out, and kudos to Larry McMillan for really initially signposting this concept back in 2012. Any questions at this point? I'll do my best to answer them. Here we go. Have to scroll down here. We have to get the great one in the morning. Okay. Recording, okay. No. All right. I don't see any other questions here, Jeff.
All right. Well, there was one question to type out the website. I did that. So.
I think we're good.
All right. Well, I want to thank everybody for coming. and we'll see you at the next webinar. Steve, thanks. Good
So
job.
it's kind of like a spread trade? No, it's not a spread trade. You're simply buying long stock or shares, excuse me, of the XIV, or you're going to be in cash, or you're going to go long the VXX. And those are exchange traded products. You buy them like shares. They're totally acceptable in an IRA or in a 401k. You're not trading an options position or a futures position. You're simply going long shares of either of those two exchange traded products. Is there an ability to hedge against large moves in the VIX, or do you not need to protect? We don't have a hedge. It's just built in that you're going long one of those two, and then that's it. You would exit once the we'll send you the alert to exit, but when the indicator drops below those thresholds or goes above it and goes into the cash range there between 0.83 and negative 0.6, that's when you're in cash. And otherwise, you do have to, there are some drawdowns that are possible. For example, in a drawdown, what happened like this is if the market is going up and up and up, and the XIV is going up and up because of the VIX dropping, well, then when the market does have an intermediate correction and it comes down, the VIX goes up, the XIV drops, that creates a drawdown on your position. Now that drawdown can happen while the daily roll is still strong. All right? And remember, we're doing a 15-day moving average, which is a lagging indicator, but we're going to, here you can see the effect of staying in the position through that lag, and then the market corrects, then turns and goes back up. We're not going to get out of the position until that indicator drops, that 15-day moving average drops into the, or goes back into the cash segment there. So that's when drawdowns have happened. But there's portions, if you look at that equity curve, where the line does flatten out, and that's when we're in cash, and it just stays flat there. There are seasons, and if you were to look closely at the 7-year, look at this one. You have some portions where you could see some flat lines there, sometimes lasting for several weeks, where the system is in cash, where it just plateaus out there, little flat points. And so that is possible, where the daily roll is just not going strong in either direction. The system stays out, and probably wisely so. And we found out, we've been developing this since 2012. We've discovered that there are periods where you want to just stay out if the wind isn't strong enough in a given direction. Why jump in when it could probably just chop you up a bit? All right. Okay. So let me see here. What other question? I meant the VIX diff or the roll effect. The VIX diff or the roll effect. Okay. Need to protect? No. No need to. I meant that. Okay. Does it make any difference whether the market is in contango or backwardization? Well, that's kind of what we're talking about with the VIX futures. Yeah, I mean, that's what we're talking about, the term structure, the price structure of the VIX futures there, whether they slope upward or downward makes a huge difference as to whether we're going to be in XIV or VXX. Okay. What types of drawdown should we prepare for? Well, as I showed you, the greatest drawdown we have was 46.5% of that 10,000. Okay, so and now that occurred, after a period. Now let me go show you. I'll even go up and take a look at the equity curve. You'll see that. Here it is. All right, and that occurred. Let's see, 9/7 to 9/13. So you can kind of see there, that's after we had already doubled, the system had doubled its money, and then it occurred a drawdown in September of $4,600. Now that drawdown is the basis is that 10,000. So keep that in mind. Okay. So it is volatile, and what we advise folks doing, that if you're going to do this, take capital that you're willing to allocate towards a volatile equity curve, for sure. I mean, you want to be careful about that, because it can, you can see here, it can be volatile when you have the pullbacks that the market can give us. The average trade duration, well, as I've shown you here, you're looking at roughly each of those three that we've seen. I don't have the one for the 7-year back test, but these three you saw was about 3.5 months for each of them. So you're in it for weeks and months at a time on a given position. It's definitely not days and swing trading and all that. Once you jump in, the system tends to stay in for a period of weeks. All right, and then we'll just shoot you an email along the way when it's time to do something else. All right, how long have you seen a position drawdown before it goes back to even? Well, if you could do the analysis here, it's looking like 1.5 months so far, at least since we've gone live. Since we've gone live here, where you have a drawdown and then it comes back to even about 1.5 months later. That's what I'm showing here. Okay. And if you're interested in seeing the multiple year results, we do have those trade by trade results, and let me show you what I just printed that out. It's this one here. Going back, and actually the first trade here ended up being at the beginning of 2010, and then going forward. We started monitoring it in 2009. I assume it was in cash, but then 2010 is when the signals fired, and then I do have the T-log showing the specific dates that we were long the XIV or the VXX and the gain and loss of each of those trades leading up to this 2 million mark. That is available for you if you would like to do more research there. And if you were to call our reps in the office, they could shoot that over to you. That wouldn't be any problem. I have that file. It's just a one-pager for you. Okay? Awesome. Again, next steps, check out the book, the ebook, check out the video that Len's made, and if you're interested, we'd love to have you aboard as a subscriber. Seeing some good success here. Okay, Jeff, I think that's it. I don't see any other questions.
Okay. Well, thanks for coming. Good job. And everybody, thanks for coming as well. We'll see you at the next webinar. Have a good evening, everybody.
Thanks a lot.